Hello, everyone. I'm Dr. Luis Torres, research economist with the Texas Real Estate Research Center. On today's program, we're talking about issues impacting Texas commercial real estate markets. Here with me are research economist Dr. Howard Hunt and economist Dr. Jim Gaines. Welcome, gentlemen.
Thank you, Luis.
Thanks, Louis.
So how was commercial real estate affected by the pandemic? Which sectors thrived and which sectors contracted?
Well, the pandemic obviously had a pretty marked effect on a lot of things, our lifestyles and what people do. Two major issues that come immediately to mind. One is, of course, the remote work or work from home has affected the office space demand. So people who are now working from home instead of going every morning to an office and occupying space changes the overall total demand for office space. And it's still shaking out. We know that there's some businesses, particularly those businesses that don't rely on person-to-person contact, that are even telling their whole workforce to work at home. Facebook, Google, those kinds of businesses, and so forth. And statistically, we've gone from historically something like less than 10%, 8-9% of the workforce working remotely. At one point last summer, in June, July, that got as high as 40% of the workforce working remotely away from the office. It seems to be coming back somewhere into the range of about 20 to 25%, which is still magnitudes bigger than the norm. And now that's a little bit of it's taking some time to shake that out through the real estate part because of the way that leases for office space generally run 2 to 7, 8, 9 years. So it's going to be a matter of companies and corporations figuring out what their real office space demand is and then adjusting it over time as these leases renew. The other side of the coin was on the retail sector in particular. We know that when we had the lockdown or the stay-in-place, shelter-in-place back in the early spring last year, March, April, May, and on in, everything stopped. People stopped going to the stores other than grocery stores and essentials. So all of a sudden there was no retailing going on. Restaurants were forced to close down. Personal services closed down. Barbershops, hair salons, you can name it, a dozen different kinds of businesses that rely on people to come and do get their buy goods or buy services. And those have stopped out. So all of a sudden the retail market was dramatically affected, although the retailers were very quick to adjust. They discovered curbside pickup, home delivery of services or goods, particularly food, restaurants and so forth. If they couldn't have diners in the dining room, at least come and pick up and carry out and so forth. The third sector of the commercial real estate market was the warehouse sector. And of course, what did pick up was the e-commerce, buying online. Amazon, Walmart online, Target online, Wayfair, a whole bunch of other organizations that provide online retail services, and they have to have warehousing and distribution services. So the industrial side of things kind of held up pretty well. So the pandemic had a very definite impact, and it's still going on. In fact, my opinion is it'll still take another year or so before we really work through the marketplace all of those effects.
Yeah, on the retail side, you had the businesses that were considered essential versus non-essential. So the ones that were essential took advantage, your Home Depots, your Lowe's, things like that. But then you had restaurants that really got hurt. Movie theaters got hurt really bad. And then on the office side, like Jim said, I mean, there's this big discussion about what percentage of your workforce is going to come back to the office. So, I mean, it's kind of an unknown so far. I think there's a lot of optimism that by this time next year, there'll be 80, 90% of the people back in the office. I don't know if that will be the case or not. And there's this whole thought of prop tech where you say, okay, I realize that managers want everybody back, but we should really dig into what the employee wants. I mean, does the employee want to work a hybrid model? Do they want to work in the office? Do they want to work strictly from home? So once we shake that out and find that out, it'll be better to figure out how much office space we'll actually need.
If we were to order them by performance from best to worst, the three sectors, who would you put at number one? Who would you put at number three? Who would you, number two? And which one would you put at number three?
Well, I probably,
best on performance.
And we can add in a couple of sectors. For example, probably the hardest hit was the hotel and motel industry, because when people had to shelter in place and with travel restrictions the way they were with the pandemic, everybody just stopped going and using. So the hotels and motels really suffered tremendously. I mean, occupancy rates, daily occupancy rates went to almost zero there for a period of time. And even today are not particularly high. There's still, people are hesitant to go. So that would be probably one of the hardest hit. Between office and retail, they tend to be localized. So in some markets or in some areas of markets, the office market might have been hit harder because of the way that the business is run, though, because of longer term office leases. In terms of the rent collections and income flow to landlords and so forth, and the payment of rent by the businesses, the office sector is a little slower there to react. So retail probably was number two. The retail sector, particularly the small retail, the freestanding, was hit pretty hard. Other parts of retail weren't. So it's one of those kind of things. It's a real mixed bag. The least affected, or the one that probably has weathered the storm best, is again warehouse distribution. That sector has come through in pretty good shape, and in fact, the statistics I think would indicate we're still continuing to build more warehouse distribution space around the country, and particularly here in Texas, because we tend to be a major distribution center.
Yeah, warehouse is doing really well. I mean, warehouse, depending on whose numbers you look at, probably averaging 5% vacancy. And rent growth is probably the strongest of all the sectors, 6 to 8% rent growth, something like that. So industrial is doing well. I guess the concern in industrial would be the possibility of overbuilding at some point, because you've got a lot of institutions that have to place money, and they have to place it in real estate. And so it seems like the fair-haired boy right now is industrial. And so that's something to watch to see possibly if we get to an overbuilt situation at some point.
So Jim kind of mentioned it a little bit, and that was going to be my next question. Did the pandemic affect the four major MSAs in the same way? Was there a different? You mentioned maybe office, Austin could be better off. Houston office always is a worry, right? There was always a comment that they always overbuild. So do you think there were differences between each of the four major markets here in the state of Texas?
One of the worst markets in the country supposedly is Houston as far as the office market. But it was struggling before the pandemic just because of oil and gas downturn. But it's coming back. And I think in most of the markets, you're seeing that we've pretty much bottomed out and things are turning around. It's just going to be a bit of a slow slog for office. But Houston, I would say, probably got hit the worst because they were already hit. And then the one that fared the best, according to the numbers, is actually San Antonio. San Antonio is a smaller market. It's a very stable market. It's not like a Dallas or a Houston. So that would be the two extremes on the office side.
Well, if we start from worst to best, probably the sector that was affected most by the pandemic as a real estate use was hotels and motels, because once everybody sheltered in place and stopped moving, and of course the airlines stopped flying, traffic stopped around the world, to be honest, but in the U.S. and in Texas. So the hotels and motels just went from normal operations of average daily rate and occupancy to almost nothing for a couple of 3 months, and then it is just slowly and gradually come back as people finally get back into the groove. So first off, probably sector-wise, you'd put it hotels, motels. The office sector and the retail sector is probably about the same and varied from location to location and then subsector, the Class A office versus Class C office, and the malls, which were not doing well anyway before the pandemic, down to freestanding retail. Those were affected a great deal. Retail probably number two, because people quit going to restaurants, they quit going to barbershops, they quit going anywhere to retail shopping. All of the e-commerce that we mentioned a few minutes ago picked up and replaced all that. Now the grocery stores did all right as a subcategory of all that. They did okay, and the drugstores did pretty well. But the general retail, then the big box retailers did okay. The Lowe's and the Home Depots and so, because we went into the home repair. People were at home and having to shelter in place or stay at home, so they started doing all those at-home projects, and they were deemed essential. Essential companies. So they stayed in. The office market, a little bit different because of the way that market works. It's slower to react because of longer-term leases and so on. But with companies going out of business, obviously, that affects ability to pay rent, and that comes into play. So we see that impact going on, and there it's variable. And then lastly, the least affected was the warehouse distribution because of the growth of the e-commerce, people having to buy things online, get it delivered, and so forth. That particular use actually increased dramatically in terms of its overall strength of the market.
Yeah, you had people that switched from services to goods because a lot of the services were closed. So that was an issue there. On the office side, a big issue is how many people are going to come back from remote work. It's hard to say at this point, but the brokers I talk to think by this time next year, 80-90% of the people will be back in the offices like before. There's a group that's called Prop Tech, where they look at exactly what the tenant or the worker wants to do as far as, do I want to work at home? Do I want to work at the office? Do I want to have a hybrid model? So if companies do that, they'll figure out eventually, okay, what's my workforce want to do? And then we'll know. But right now it's kind of up in the air as to, what percentage of workers really want to come back.
One of the other interesting things that we probably should throw in is that statistically, I'm not sure we've seen value impacts, because we're talking about occupancy rates, rent rates, and so forth. As the rent rates have either not gone up or actually declined, say in the office sector, then revenues, and in retail, then revenues decline. And generally, if revenues decline, the value of a property declines because it's a direct relationship. But there's a lot of investor interest, and that's another area of the commercial arena that we need to at least identify, that there is still investor interest. Some of it, funds being raised in anticipation of a general downturn in property values, and to come in and be opportunistic investor. But we haven't. It's interesting that really on that score, from a statistical side, we haven't seen that come into play yet. Cap rates haven't changed that much because interest rates haven't changed that much. Now that could change again in the coming year.
Do you think it's related to still waiting to have a clearer picture of the future, right?
Yes,
maybe they're still waiting on that, no? Because it's kind of right now it's difficult to know what's going to happen. I know you mentioned, Harold, in a year they're expecting everybody to come back to the office. Well, I'm not sure about. I don't think everybody's sure about that, right? I don't know. You can with 100% confidence say that, no?
And you're exactly right. That's right now the uncertainty of which way all this is going to go over the next year to year and a half to 2 years is what's holding things back. But it's not a collapse, particularly on the value side, price side, and even activity. There have still been commercial properties being bought and sold during the past year, not quite as active as it was pre-pandemic, but it is coming back. But we would have expected to maybe see more of a collapse in property values than what we've experienced.
We're seeing good construction too, especially on the industrial side. You're seeing a lot of new construction industrial. It was interesting though, I heard a guy speaking yesterday saying, if I wanted to build a new building today, I'd have to wait 10 months to get the steel. So although that's in my mind down the road, it may be a problem that industrial could get overbuilt because institutions have to place money. A limiting factor may be the supply chain where they just can't get the material to build a building fast enough. We'll see.
Earlier, you kind of talked about it, Jim. You kind of mentioned that there was some differences between the MSAs. So were there any differences? Did both of you, Harold, Jim, saw some differences of the effects of the pandemic on the MSAs by sector?
I guess the Houston office market was probably hit the worst because they were already hit before the pandemic started. They're one of the worst markets in the United States as far as vacancy currently, but they had problems before the pandemic hit. The market that's actually doing the best, according to the numbers, is San Antonio. San Antonio is a smaller market. It's a very stable market compared to Dallas or Houston. On the retail side, I would say Austin is probably doing the best in retail. On the industrial side, it's Dallas. Dallas is the distribution hub. It's showing the best numbers for most things, for vacancy, for people looking for leasing. And so Dallas is really kind of the star there. Houston is doing okay because of the port, more port activity. San Antonio and Austin, smaller markets, they're really not distribution markets on the industrial side.
Yeah, you have to take into account the different economic bases of the different MSAs, and they're all a little different. As Harold was talking about, Houston with the energy relationship and the oil and gas market actually started its decline several months, almost 4 or 5 months before the pandemic started. And that was when the price of oil started declining in December of 2019, when the Saudi Arabians and the Russians decided to have a price war on the price of oil. So that started earlier, and it's still played out during most of 2020. And it's interesting because we now see the price of oil going back into the low 80s and expectations of it continuing to increase. But that energy sector hasn't come back, and in fact is still, just this past week, Exxon is talking about consolidating employees to its campus up there on the north side and vacating nearly 500,000 square feet of office space up in the Woodlands and that kind of thing. So it's still in transition, it's still kind of fluid. Dallas, the distribution center, services industries, financial services and so on, the banks and so forth are now coming back again. So their office demand, their base demand for office space is a little bit more stable than, say, Houston. In Austin, with the higher tech, those are people that can work remotely, and so that didn't tend to get as overbuilt. And then you've got new development happening over there with the Tesla and other things. Population growth is still, and job growth is still fueling it. And in San Antonio, as Harold said, being so stable, just good, slow, steady pace to it. It's the hare and the rabbit and the turtle and the tortoise, the hare and the tortoise kind of thing, with San Antonio being the slow and steady market.
Yeah, corporate relocations are really helping too, like Austin and Dallas. In Austin, you've had Tesla and others are looking at it. So that employment is really strengthening to me right now. And it looks like we bottomed out in most all the commercial markets. I think the trend is up.
So you jumped my question right now. So how are they currently performing right now? How are the markets currently doing in each MSA and each sector?
Right.
Well, currently, office is still struggling. I would say retail is better and industrial is obviously the best. Probably in industrial, you're looking at 5-6% vacancy, something like that. On the retail side, it's probably between the four markets, 7 to 10%. But then when you get to the office market, depending on whose numbers you're looking at 15 to more than 20% vacancy, other than San Antonio. Now, San Antonio, according to the numbers, is about 10%, but there again, smaller market, stable, different economy.
Different economy. And you know, our discussion here about the commercial sectors is and you can tell we're not throwing out a whole lot of hard statistics because there aren't a whole lot of hard statistics. There are providers of data, and what we've discovered is that they're not always together, that the numbers can vary from here to there, or they have a range to them because of how you count things, what you count, and then there's classifications, Class A, Class B, Class C of all of these. And then like in the retail sector, if you take away the regional malls and the big shopping, which were already suffering and were already in a trajectory of decline because the world has changed and the malls were no longer, so the pandemic just accelerates some of that because a mall depends on concentration of people being in an area, an enclosed area. Well, the pandemic did away with that. The hotels and motels are beginning to come back. They're getting up occupancy rates. The room rates are still pretty good. So if you ever wanted to go to one of your big deal hotels, this is probably a good time to look at what they're charging on the rates because and it's fluid. It seems like it's gone up and down. This past summer, May, June, July of this year, that the rates were starting to go up, but then the Delta variant of the pandemic hit. And you can see statistically that the demand for things like hotel space, retail activity declined again. Stores were enforcing masks and spacing, and some even shut down. So we've gone through this wave. It's been a roller coaster ride, and we're still waiting for that to level out a little bit. So it's hard to give hard numbers on some of these points.
You kind of mentioned earlier, everybody's talking about the hybrid work environment, the hybrid retail model. Going to that, people are working from home. You mentioned that the COVID-19 accelerated processes. The technology was already there, the ability to work from home. Zoom already existed, right? The thing here now is that we actually used it and we found it's productive. Going back to something you also mentioned, the employment numbers. It's incredible to see the employment numbers. Fire jobs, business, financial jobs are back to pre-COVID levels, but vacancy rates are not in offices. So people are working from home. They hired more workers and they're not in the office, a lot of them. Now, the hybrid retail model is also interesting because, people initially thought, oh my God, e-commerce can destroy the brick and mortar, right? You made a good point, Jim. You mentioned the malls of the past. I think the malls of the past are partly gone, right? But the new malls, like the Domain in Austin, all these new concepts where you have restaurants, other experiences, people still want to go there. The story a couple of months ago was on Amazon. They're going to actually open a retail store where they're going to offer clothing because clothing is really difficult still to do it online. I think, 40% of the things you buy, clothing, you have to return. So you need that model. So going forward, I know it's not that easy. What would you expect was going to happen to office and retail with the hybrid work environment and with the hybrid retail model? And maybe how is that going to affect industrial also?
Well, one thing I heard about the office that was interesting to me that I hadn't considered is the new buildings, the new Class A buildings, for example, versus the old Class A buildings. And, we've got a lot of really nice buildings downtown that are Class A, but they're 40 years old. And so a big issue evidently that's come up with tenants is air quality because of the virus. And some of these new buildings have very sophisticated air handling, air cleaning systems, and that would be something that'd be really hard to implement in the older buildings. So you may have some issues of attracting new employees to new buildings that have a lot of new technology and things of open space that the old buildings don't have. That may be a factor in who does well and who does okay on the office side.
So what implications does this have for the downtowns?
Well, we know that traditionally the downtown or the core business district, the CBD, that was where the center of activity always historically was because of transportation systems. It was a hub and spoke kind of arrangement. And that was true for the last almost 100 years. And it developed that way. But we can see from the pandemic has accelerated going out. For example, in the Class A office market, you couldn't be a Class A building without being in the downtown. You couldn't have Class A outside of the downtown historically. Now that's not true any longer. We've moved out from that. We're getting away from that. And so one of the real impacts of the pandemic has been to accelerate the spatial movement of properties out. And this is also being exacerbated by the millennials, the younger generation coming along who want to live further out. They want the space. They're not willing to sit in traffic for an hour to get to a job at an office where they don't need to be there in the first place. That goes back to the working at home versus not working, or working part-time in the office and then part-time at home. So it's spreading out. It's interesting that in the last year, in discussing all of these impacts of the pandemic, the two words I haven't heard anybody really ask, like reporters and others, or use, the words urban sprawl, which 10 or 15 years ago were the two dirty words of real estate, was urban sprawl and the planners and all. But that's what's happening. The evolution is that we are sprawling, if there's such a word. The spatial distribution of houses and retail and office and even industrial is moving further and further, and the central business district is no longer the 100% have to be there area. It still will play its role. There'll still be a central, but what we'll have is we'll have other market centers or activity centers, whatever you want to call them, that will evolve, and then things around those. And that's been coming for years, but I think the pandemic has probably accelerated, particularly with the remote working and the technology, the technological revolution and expansion of technology, and the pandemic of realizing that on a spatial basis, I don't need to be there. I can be anywhere and do my work and live pretty much anywhere. And this is going to help some of the ex-urban counties and areas where heretofore it's been difficult to get people to live there. There's going to be a revival of that. Now that's a little bit longer term. That's not next month. That's not next year necessarily, but it's coming and you can see it coming.
It's funny you mentioned this because I remember when I came here to the center 8 years ago, and I remember the conversations we had at the office. Everybody was talking about how everybody wants to live in the downtowns, in the cities. Nobody wants to buy houses. Nobody wants to move to suburbs. Remember that?
Right.
The idea at that moment was, oh my God, everybody's going to live here. The millennials are not getting married. They want to live in an apartment. And no, it's a total reversal in a couple of years and accelerated that process.
Well, one of the interesting things is it's not as definitive. It's not an either or. We have now in Texas and in our major metropolitan areas in Texas, we have a large enough population base that we're seeing demand for both. We're seeing the demand for the sprawl. We're seeing the people wanting to move out, the millennials who are now 35 to 40 years old or early 40s moving out. But we also have a tremendous number of people of 20-somethings that are coming into work. And yeah, they're still looking to live in urban-centric kind of situation. So the irony is that we're seeing both. And so it's not that it's one at the expense of the other. It's not a zero-sum game. We can do both, and we're seeing that kind of thing. The thing that's lagging, of course, is infrastructure, transportation, utilities, and so forth. And that's going to be the strain on the growth of the future, both commercially and residentially, in Texas. We're already feeling that strain and that constraint, and it's going to be even more pronounced going forward.
And on the retail side, the brokers I talked to said that suburban retail actually did better during the pandemic than down. And because I guess a lot of it is more goods related versus service related. You had restaurants and things like that were downtown, much more heavily service oriented. It'll be interesting to see if that continues over time.
Yeah, and go back to your points. Like, I agree with you that, I don't know, sometimes people get, maybe it's the story, but they get catched up with those zero-sum games, right? It's this or not, right? Suburban is going to be destroyed. Oh, the downtown's going to, no, I agree with you. It's never something in between The majority of the times it's something in between, but those extreme ideas, I don't think at the end of the day don't play out as the people think, right?
No, both areas have their own attraction, their own natural amenities and features and value propositions that they offer. There are still going to be some businesses that need, because of they're complementary, so they need to be located close together. Historically, that was the CBD. The reason it was that way was you needed to be close to the banks. The banks were all in the CBD. You needed your business to be near the bank because you relied on the bank to finance your business. Well, that's now, with the technology, you might be using a bank in another state, in another country. So you don't need to be physically near that. Now, you might need to be near another complementary business. So hotels want to be near where the offices, so the business travelers can be convenient, and those kinds of things. But those will work out over time.
So just to round out, so what do you expect for the remainder of the year and for next year for commercial real estate here in Texas?
Well, I think it's bottomed out. I think things are looking better. Employment growth is better. The pandemic seems to have calmed down a bit. You know, the Delta variant 3 months ago was a big deal. Now it's not such a big deal. I think industrial has sort of got the wind in the sails compared to the rest of them. Rent growth is strongest in industrial. Then would come retail. Retail's doing good. I guess there's a concern about maybe new space coming on in retail. Will there be too much? I don't see that yet. But I hear the brokers saying that most of their leases are being from smaller tenants, shorter term. They don't mind paying more, but they're a bit uncertain about the future because of the lasting effect of e-commerce. So that's something we don't know. Is e-commerce going to continue to be as big or bigger than it has been in the pandemic? And then on the office side, that's the one that struggled the most, but still, I think we've turned the corner and things are improving with job growth.
Yeah, one of the interesting things about almost all the commercial markets, office, retail, industrial, hotels and motels, so on, over time, those markets tend to swing like pendulums. They go from really good to really bad and really good and really bad, and it's very rare that it's actually in the middle somewhere or in balance. It's generally moving, but that's the nature of the world. And for example, in the office market, it takes several years to build new office space. So you start planning 2 years ago to build an office building, and all of a sudden a pandemic hits. Well, you don't have any choice but to complete the building. It's going to get built, and it's going to come online, and it may sit empty, or you may have to lower your rent expectations. So you have this volatility that it's sort of a natural feature of commercial markets. And I think Harold is exactly right. We probably have seen that pendulum swing as far over on the downside, if you will, as far as it's going to go from the pandemic effect, and is now swinging back toward a good side, the positive side. But it'll take it a while. And how long that'll be is hard to say in terms of occupancy rates, in terms of rental rates. If you're an owner, if you're an investor, you're looking at rental return, net operating income, capital appreciation, capital value of the property, as opposed to a user of the space as an investor or owner of the space. And those are two different points of view completely. The investment is still there. The appeal is still there. Institutional investors still look at commercial real estate as, in the longer run, a safe, a profitable place to place investment funds. And so they're looking for that. Some of the opportunistic investors are looking at thinking there's going to be depression in the market and they can come in and pick up things at lower prices, which I don't think we're going to see that much of. There may have been some of that, but not nearly as much as what people might have anticipated. So it'll be interesting to see how, again, the pendulum swings back and forth on these things. And it'll swing at different rates in our different MSAs. So Dallas might be a little further along toward the other side than, say, Houston, slower, and San Antonio doing very well. Austin has been our most volatile market, but it's also been when it's been up, it's really up. and it's very, very strong.
So that's it for this edition of Texas Real Estate Research Today. Harold and Jim, thank you for joining us.
Thank you.
Thank you.
And thank you for watching. For more on this, download our 2021 Mid-Year Texas Commercial and Economic Outlook. Until next time, please follow us on Facebook, Twitter, LinkedIn, and Instagram. Bye, everyone.